Hey there, this is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, Where Do We Investors Stand? It is Friday, March the 7th, 2025. Let's get started now. It's been another challenging week, to say the least. So let's take a look here. We'll sort by usual here. And, Bitcoin up on the top of the list, but really just continuing to bounce with inside of a big range. Down on the bottom, you can see crude oil actually falling almost to kind of new lows for the move. Kind of breaking lower. Small caps were faring the worst, but again, there's lots of damage underneath, and I think the indices actually hide much of what's going on. So let's look at, again, remember, we got a short-term trend, it's turned down a lot of equities here. Intermediate term trend has turned down a little bit, but we got to step back and we got to zoom out. We've got lots to see. So reminder, push your video player if you want to push pause there to take a look at something in greater detail. So the S&P 500, that is 500 stocks in the US, we are weekly oversold. Now, what does that mean? It means that the market has come down, right? And essentially, as you can see by the green circles in the bottom, this is something that actually usually happens about once a year. It's not a common occurrence, to be honest. And so when you have to think about what we can do as investors, right? There's three reactions that we can go and we can have inside of price weakness. One is like, not even notice and go about your life and accept that markets move around. It's true. Option two would be to panic and to unload your stocks and sell your portfolio and try to adjust and in the face of fear. And again, I'm just going to generally point out here that in the face of oversold conditions, the risk is very, very great, that there is tremendous whipsaw risk. And that is not a recipe for saying that someone has to be aggressive, because that's another matter, right? Option three is to say, hey, there must be opportunity here. What can I do to take advantage of it? But you can see in a bear market like in 2022, we can have oversold multiple times, and that's perfectly normal. At the same time, bear markets don't come around all the time. And so again, if you look at the top panel, the S&P 500, we'll look at it in more detail. I think it's premature here to sort of start getting overly excited trying to talk about big picture tops, but I understand there's certainly the opinion is out there. Here's the Russell 1000 falling below that line. That was the gap line from the election right there in November. We had a spike low a couple days ago, meaning a lot of lows, a lot of stocks hit lows. But again, we haven't really seen a kind of movement further in that direction. In fact, yesterday in the large cap market, we had large caps with more highs than lows, even though the market again is kind of continues to be troubled here. So here's the S&P 500 on a daily basis. And the reason there's two red circles on here is both those red circles are moments when there is essentially a lower low relative to, obviously a prior low. So right now, here we are again, we are making a lower low, okay? So in the bottom panel, we've got, a MACD here essentially. And so again, I've just got the idea of when a MACD, which is kind of moving averages, start to turn upwards, especially from a low level, those tend to be buying opportunities. Now, again, obviously you can see we're not turning upwards here, but the point I'm trying to make is that even in the context of an uptrend, there's nothing wrong with making lower lows. In fact, I would argue it makes it sort of more of an intermediate term correction and or entry point if, of course, the market continues higher. Now let's take a look at the volatility index. So this is volatility versus the S&P 500. Volatility in the red here, you can see we have not even made higher highs here than December, which is interesting. So the market has gone lower than December. We just talked about that lower low, and yet volatility has not. So volatility is above that horizontal line around 3, which I call into the zone. And now what we need to see is we need to see volatility settle, which essentially provides an equity buy signal. Let's zoom out again here just to kind of keep an eye. You can see here when we look at distance from highs, it gives you a sense of sort of where the relative strength is as well. So gold on the left, only down 1.5% from all-time highs. Gold has continued to benefit here from risk off in other assets. And then Bitcoin, again, clearly an uptrend. I mean, higher highs, higher lows. There's not much more to say, but it is off 18% from all-time highs. And then there's the S&P 500, which we've just talked about making a lower low, but again, 6.5% from all-time highs. The problem is underneath that stock market, there's a lot of stocks here that have come down a whole lot more than 6.5%, and that's the trouble. So let's look at Nvidia, of course, everyone's favorite stock here. So again, I pointed out yesterday on X that this is the first time in it's the third time in a decade whereby we've had a 34-week moving average, which is plotted in green, rolling over and starting to turn down. Now, what does that mean? It means we've got wear and tear in the stock, right? So in the last kind of 4, 5, 6 weeks, Nvidia's been kind of stalled out here. And so again, it has been a massive beast of a stock. It is widely owned, widely talked about. And again, it's not to say that it has to come down here, but again, technology's already been weak, and Nvidia is a big piece. And at this point, again, it's just a simple acknowledgement. I look at that and use a 34-week moving average as kind of a last line of defense if I were long the stock, which we are not. At the same time, again, a lot of investors do not want to accept that stocks can come down. And the reality is we we don't know how far stocks can fall down. Some of these past drawdowns have been quite significant, even though in hindsight, of course, if you knew perfectly well the stock would always climb, yeah, you'd never need to sell. I get it. Let's look at door number 1, 2, and 3. These are the technology stocks. There's NVIDIA right in the middle. You can see that's a 28% drawdown from recent highs. Broadcom is a widely owned stock here. Certainly our clients are familiar with that one. Also down pretty similarly, 28.8%. They announced earnings last night after the bell. And last I checked here, it looks like the stock's going to bounce 10% in the pre-market, which is good. Be interesting to see whether that sort of brings some life back to the market in general and maybe technology more particularly. And then you can see, again, sometimes stocks fall apart. Marvell Technology reported earnings this week, and again, the stock is now down 43% from its highs. That is a lot, right? And even though we can sit here and I can tell you, hey, I see higher highs, higher lows, 43% down is a lot to have to stomach if you're an investor. And so again, I believe you have to manage risk all along the way. Stocks do change character. Stocks do change. They do peak. They do bottom without notice. Let's look at a couple of other stocks here in the financial sector, which has been very, very strong. You can see the difference here. So here's 3 stocks, Jefferies on the left, Interactive Brokers, and Fairfax in Toronto. You can see the relative strength lines in the bottom. And so for whatever reason, Jefferies on the left, it broke down. That is no longer sort of a nice looking trend. It's not very tight. It's not very contained within its sort of where it came from. And so the reality is that, if we own the stock, we would have stopped out several weeks ago, and we did. That's the way it goes. And so did I know that the stock was going to keep going lower? No, of course I did not. But at the same time, we have to be able to adjust. So this is what I want to point out here. This has been, a very harsh period of time, because the last couple of weeks, which is what we've got on the screen here, you can see the magnitude of the damage here. Because look at gold. There's gold barely down. We just talked about that. The S&P 500 down 4.6% over the course of the last couple of weeks. But look at the stocks here that, again, certainly I've talked about many times on this webinar. Intuitive Surgical, Coinbase. There's the ARK-F. That's the strongest of the ARK funds, is down 10. There's the Adaptive Select ETF down 10. DraftKings 12. Interactive Brokers we just looked at, still an uptrend, but down 13. There's Broadcom down 18, and there's Tesla down 22. So again, the problem is that in a downtrend, stocks, of course, tend to be more volatile, and more volatile means more falling more. And what's been happening recently certainly is that the stocks themselves are definitely falling more than the market. And so insulating yourself through ETFs is one way to attempt to go and stem the damage, but at the same time, it's very, very tricky. So remember, stocks are more volatile generally than ETFs, and ETFs are more volatile than an index ETF, if you will. Let's take a look here at Sector Watch to finish off. You can see gold stocks up at the top of the list here continue to show pretty good relative strength. We did talk about AEM last week. And down on the bottom, we've had energy stocks just kind of following through here with crude oil, which has been pretty weak. But again, lots of negative headlines for sure. At the same time, there is sort of things happening certainly overseas, but again, lots of it is to do with currency. And so again, we're in a very noisy period with all this trade war and tariff business going on. So I will keep you posted. Please follow me on X. I'm at David Cox RJ. Thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially in Sync in Waterloo, Canada.